You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors.
Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. Tom is out for the next few weeks, but we have a lineup of surprise guests and co-hosts in his absence to discuss various tax topics on our show. Today, I'm joined by Alex Savage, who is a senior tax advisor at our firm. We break down the best practices of house hacking, along with some common misconceptions, and how to maximize tax savings when selling the property using a combination of strategies and more. If you're currently house hacking or interested in house hacking and want to maximize your tax deductions, this is a must listen to episode for you. We'll be diving into all that in just 1 minute.
Hey, are you ready to discover how to use real estate to build tax-free wealth? Well, this year we're taking our annual summit to the next level by incorporating wealth building strategies alongside our traditional tax and legal insights. Thus, we proudly introduced the 2024 Tax, Legal, and Wealth Summit for real estate investors taking place May 17th, 18th, and 19th, right from the comfort of your own home. This extraordinary free 3-day virtual event is meticulously designed to arm you with the strategies the 1% use to cultivate tax-free wealth through real estate. Whether you want to build, safeguard, or grow your wealth, this summit is your golden ticket. Visit www.taxandlegalsummit.com to reserve your free tickets today. Again, that's www.taxandlegalsummit.com to reserve your free tickets. We'll see you there, but for now, we'll dive right into today's episode.
Hey, Alex, thank you for joining us today. Hey, would you mind giving our listeners a little bit of information about you?
Yeah, absolutely. Thanks for having me, Ryan. I appreciate it. So I grew up in Des Moines, Iowa, and I'm currently located in St. George, Utah. I'll tell you a little bit how we got here in a second. I played basketball at a D3 school in small town Iowa, where I met my wife. Recently got married about 7 months ago. And that same month, we moved down here to St. George to get outdoors a little bit and explore and see some of the world. It's a different part of the world. I've been in Iowa my whole life. So I started out in a mid-sized accounting firm. We served a lot of local real estate investors. And I started to realize that these wealthy people paid little to no tax and really got the gears going of real estate investing for me and really started to found a passion to dive in deeper into real estate investing. I did have a misconception starting out that you needed a lot of money to get started, and that's certainly not the case. And it took me a couple of years of research to figure out why that is or how that is or what strategy to use if you don't have a lot of resources, being a young 20-year-old kid out of college. And from there, I think like most real estate investors found bigger pockets, especially back then, and dove into podcasts, books, webinars hosted by Brandon Turner. And that really got me down the rabbit hole of house hacking and really wanted to get my first deal done. And so it took me about 2 years from there to really pursue that first deal for real. But that's a little bit of my journey about how I got started into house hacking, a little bit about my background.
Yeah, I know a lot of people get started with house hacking. And I feel like that's a new phrase, but it's not a new idea or concept. People have been doing this for a long time, but I think made popular by bigger pockets for sure, as they talked about on their podcast and things. But totally, man, I agree. It's a great way to get started, especially when you're young. You're looking to get into real estate. You like real estate as an asset class for yourself. And we all need a place to live, right? So why not get some of that help from tenants and so forth to help pay for some of that rent and the cost of that.
Absolutely.
So, well, as we get started talking about this, I think just it would be good to start with, talking about your first deal, kind of how you got into that, give us the details of that, and we'll kind of take questions off of that.
Yeah, no, that's perfect. So I completed 2 house hack deals in the Des Moines area, different parts of town, but I'll get into those here in a second. What really happened was it's really a springboard for me to get out of student loan debt and create a nice emergency fund and really start building out like an investment portfolio. For me, that was a lot of like in the stock market, but it could be just keep building real estate. It could be whatever you want it to be. Once you're out of student loan debt and able to have some cash, so you're okay, like then sky's the limit and you can go do what you want to do. And house hacking really was that springboard for me to keep my housing costs low and allow that cash flow to free up. So I wouldn't trade any of those investments for anything. I would do them again in a heartbeat. However, I don't know if more house hacks are in my future. Let's put that. I don't know if my wife would appreciate it. We'll put it that way. Happy to dive into my first deal. So like I said, my misconception was you need a lot of money to get started. And then from there, it's all good, right? But what happened was I was actually able to connect with a local credit union and they were able to finance it 100%. So it was a conventional mortgage. There's a 30-year. So what happened was 80% of it is a conventional 30-year mortgage. And 20%, so the 20%, which is like typically your down payment, was a 10-year ARM. And so after 10 years, that rate would adjust, but the rate was just slightly higher than the conventional 30-year. And so they 100% financed my first deal. So what happened was I actually used that there's an IRA exemption for a first-time home buyer. And so I did have to fund the closing costs, which are about $3,000 to $4,000. And I actually was able to pull that out of my IRA to keep my cash. I'm conservative. I'm a CPA. So I like to keep my cash. So I actually pulled out of my IRA for the closing costs for that $3,000 to $4,000. And so that was able to fund literally my first deal at $3,000 to $4,000 out of pocket. Okay. Pretty minimal cost, I would argue. I bought that one for $200,000. And that closing date was 3/31/2020. That is about right when COVID was becoming real serious here in the United States, right? And so I did have a little freak out period where I was, my brother's a lawyer, so he's got connections. I was talking to lawyers like, hey, like, can I get out of this thing? And like, thankfully they talked me into keeping it. And like, hey, man, like real estate's real estate. Like you're going to want to do the deal. So thankfully I did go ahead and do the deal. My total mortgage with taxes, insurance, and everything was about $1,200. And I had about a 3.8% net mortgage rate on there because it's my primary residence. And so the rent coming in was $750 from the bottom unit, and the top unit was where I was going to move in. So out of pocket per month, I paid about $450 to $500 every month. So like super low housing costs, right? Before that, I was renting at about a $1,400 apartment. So it was a big change for me, a big savings for me. And on top of that, I was able to own a real estate asset.
Yeah, you've got appreciation over those years. I know we're going to get into selling a property and so forth. You've got depreciation, which we'll also talk about. We've got debt pay down, help from renters. We've got cash flow that, kind of there. Like if you compare maybe the difference between what you would have paid in rent to what you're actually having to pay. That's great, man. Yeah. And I was just also going to chime in here and say, while you were talking, I was looking up my closing statement for a duplex that we did the same thing, kind of a house hack. Our closing statement was March 3rd, 2020. So that was like also right around that time. So totally.
Right. Did you have a heart attack like I did, or
Yeah,
were you more cool than I was?
But at the time, I had my wife who was like buying this with her. So now it's like, hey, I got to get her input on this. Like, do we move forward? We ended up doing it, and maybe I'll kind of tie in some of my experience too in that. But yeah, continue on with kind of what you've got going on.
No, that's awesome. That's awesome. So yeah, so $750 in rent coming in, and it was actually well under market. I could have probably got it up to closer to $1,000 if I would have honestly booted them out, but it is a different dynamic. I will say this, like when you're literally physically living right above the tenant, you're more connected to them, I think, I guess, from a personal level than if you were, somewhere else and managing it from far away, or if you had a property manager on there, right? So I was able to increase it 3% per year every time their lease renewed, but I did keep it low. I just felt like the right thing to do. It was somewhat of a rundown neighborhood, and I knew pushing it to market would have forced them to leave and find a new home, and I didn't really want that. So there is a different dynamic there, definitely when you're house hacking, that you are literally right next to your tenant, and for better or worse, it has its benefits and it definitely has its downsides if you're not ready for that. So
yeah, I'm curious too. How did you get the 3% increase? I know like that to me I've seen that more common in commercial, but just in residential, was that already in a lease that you had? Like, did you work with, I think you said your brother-in-law, kind of helping you with that? How did you do that?
That is a great question. I was a complete newbie. I didn't even know that was really like standard. I've kind of heard like 2 to 3%, but it was really just like what I thought they could afford. Like I thought if I went higher, it would have probably pushed them out. But it kept me, satisfied, and it kept them there, and they were happy. So that's really where I landed on it. It wasn't like a secret, or wasn't anything that I did that was like special or written into the lease or anything. It was really just what worked for both of us.
Yeah. Awesome. No, that's good to hear. Anything else with your first property you want to talk about? Otherwise, we can talk about your second one.
Yeah, we can jump into the second one. So the second one was about a year and a half later, so a little bit over that. And so this was getting into somewhat post-COVID, where the market was getting really hot. And my cousin and I had been looking for duplexes around this same area for quite a while, like almost since I bought my first one. And we couldn't find anything that made sense numbers-wise. This one came on the market. I went and saw it that same day, and we made an offer that same night, and they accepted it that night. So they were in a hurry too. But what happened was, like, we moved fast. We made the full price offer. And, everything worked out. They actually ended up paying closing costs. So we did the same loan. So he needed a place to live. So he definitely needed to move in. I moved in for a short amount of time. He moved in for about a month and a half. So what happened there, happy to talk about how we're able to do this here in a second, but we were able to literally buy this with zero money down, same loan. So 100% finance, so the 80/20, and they paid all the closing costs, and they even made like a couple little repairs. So it was insane. So it was literally zero money out of our pockets. Again, we had that rate was like our net was like 3.2%. Rates were still going down at that time. It was a pretty incredible deal, and really, like, I think we got it just by moving fast and knowing that area. We had literally scoped that area for over a year. We knew that's where the area we wanted, and we went after it and pursued it, and it worked out.
That's awesome.
Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Whole CPA, we worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2023 and 2024 tax years, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help. But for now, we'll dive right back into today's episode.
You bought that one 100%? Or was that one that you bought with someone else?
Yeah, so this was me and my cousin. We bought this 50/50. And so we bought that for $325. And this was at the end of 2021. And so he moved in for, what happened was, so again, you're definitely want to clear this with your lender. Okay. So this is a conventional mortgage. It's not like a government sponsored loan, like an FHA. I often get the questions like, how did you do that? Like, how are you able to live there for such a short period of time? And this is something that we ran by our lender. Okay. Literally 3, 4, 5 times. Like, we wanted to make sure, like, hey, we intend to like eventually move out and rent this unit, whether it might be in a month, it could be in a year, it could be in 5 years, but like, that's our ultimate goal. Is that okay? And they were like, absolutely, like, that's perfectly fine as long as you guys move in, right? As long as you guys are moving in, we are perfectly fine with that. And so we made it crystal clear up front. We got the okay from them, like I said, multiple times. So what happened with that one was when we bought that unit was actually empty. So it was a perfect situation for us. And the other unit was actually using short-term rental arbitrage, and they're actually using it as a short-term rental. And so when we reached out to them to introduce ourselves, and as the new landlord, they're like, hey, like, we would love to have the other unit eventually too. Like, where, it'd be awesome to have 2 units right next to each other. We could have the cleaners come in, they could do both units. And so we certainly agreed to that. We just wrote up like an addendum for a short-term rental agreement for them, so we could cover ourselves from their problems, if that makes sense. Happy to discuss the dynamics of it, but it's really just a 1-page addendum shielding ourselves from that liability. And it's been a win-win for us, because what happens is we're able to actually charge a little over market. So we're getting above market rent for that property now. And they're happy because they have both units and they're making money. And we're happy because they have cleaners come in, all the time for turnovers. And we don't really ever have to hear from them. It's very hands off because they're the ones that need to manage the property. So
that's good. And how did you and your cousin set that up? Did you guys do an LLC? I know that's a common question that everyone thinks about when they're buying any sort of rental property. It's like, oh, but I live here. Like, this is my primary kind of, or maybe you talked about living there for a little bit, or even for your other house, right? It's like, do I do an LLC or do I not? So I'd be curious to hear kind of how you did that, kind of with the entity structure or not.
Yeah, perfect. On the first one, I certainly probably didn't even think about it, right? I knew that was really going to be like where I was going to live for a while. And I didn't really have any assets. To be honest with you, I probably had like more student loan debt than assets at the time. So that one didn't even cross my mind. The second one, we have certainly talked about it, or like quick claim deeming it into an LLC, which we probably should explore. However, no, we did not set up an LLC. So we're in a TIC structure. It's 50/50. So we each just report half. We're still able to take all the deductions that a normal rental property would. There's no, special tax benefit to having the LLC. It's really for liability protection purposes. And so, yeah, we still today, we still just own it in a TIC structure, 50/50.
Yeah. And something I'll just highlight for our listeners, LLC, like you said, has no tax savings. Just want to highlight that for people listening. It is just an asset or liability protection in case someone tries to sue you. We've had Ron Rohde on our podcast in previous episodes. I don't know what number that was exactly off the top of my head, but go back and listen to that. He talks about LLCs. I do want to hear from you in just a moment about kind of keeping separate bank accounts, because that's always a good practice as people think about this. But just to highlight again, no LLC. That doesn't mean you get less tax savings or anything like that. And also just to mention with the TIC as well, like you were saying, you reported on your own tax returns 50-50. You basically record half the income and half of all the deductions. If people are wondering, that just goes on your Schedule E, page 1. So nothing too unique of that. But the one thing I will also mention, people should be aware that a TIC structure is going to keep things very rigid. Whereas if you go into something like a partnership with your cousin, you guys may have had some additional flexibility in what you guys could do. But just for people listening, TIC structure, everything's going to be exactly to the dollar, split evenly, unless you've got 3 people. Okay, a third, and so forth. But in your example, absolutely.
Yeah, absolutely. Just to wrap that up, I mean, you said it very well. It's just like you're trading, right? You said it's more rigid in the TIC structure, but it's just like it's super easy to set. Like you don't really have to set up anything, right? You're going to save legal costs. It's less complex, right? You are stuck with that for the most part structure, but it is just basic and easy. And it doesn't require, a super complex structure to get going and own real estate. So I do want to talk about like our tenants and what we were looking for, or what I was looking for, and then what me and my cousin were looking for. Like I said, that second one, that unit was empty. And the first one, it was a month lease on the top unit. And so that was important. Like if I found a property and they both were leased for a year, there's just no way I could really pursue that because you can't go live there. So it's just like a little tip. You're certainly going to want to find a unit that's month to month or empty. So you are able to physically move in there, right? Like if you went under contract and you're banking on a primary mortgage with a lower rate, and then, the bank's going to ask you when you're moving in, 9-10 months, that's not going to work out, right? So just a tip up front, look for those leases that are either shorter or month to month where you are able to have some flexibility to move into that property.
Yeah. That's good. And I'm even talking with one of my partners with one of our duplexes and thinking about selling it here in Minnesota. Do we need to have one of the tenants move out so that now we can open that up to potentially having someone do a house hack like we're talking about? Or do we just say, hey, keep both tenants in there, and this is only going to be acquired by, say, an investor? But that is something even the seller is going to be thinking about that. But you being the buyer as a house hack, you've got to have that flexibility if you are looking for something that you're going to rent out some other space. So absolutely agree with you.
Yeah, well said. Then I know you wanted to touch on bank accounts here too. And so I certainly set these up. So like I said, when I connected with the local credit union, they always kind of want you to open a bank account, right? Which is actually helpful in this case. I'm not a big advocate for having bank accounts all over the place. It personally drives me nuts. However, it does help in this situation where you can have like the mortgage payment, which has your taxes, your insurance, everything wrapped into one, which is half that's going to be personal, right? And half that's going to be for your rental business. However, you can go ahead and put everything that's rental oriented through that account. Okay. So obviously like your whole taxes and insurance and everything aren't going to be deductible. Half of it is, but then everything else in that account I knew was going to be for my rental unit. Anything personal, like was for my unit, I would run that through my own personal account.
Yep.
And that just made my life like so much easier when it came to tax time. I could just pull that record from that one account. Okay, take half of the property taxes, insurance, right, et cetera. And then everything else that was in there, any repairs or any other little expenses, I knew right away that those were going to be deductible for the rental piece, right? And that also could lead us to talk about like the de minimis safe harbor. That's a safe harbor for taxpayers where it's $2,500. And anything below that, if you make the election, you're able to just expense right away. And so I took advantage of that every year. So any expense or anything that I replaced or any appliance that was under $2,500, I knew to just go ahead and make the election and just go ahead and write those off as an expense in the current year rather than capitalize and have to depreciate it and, get that benefit over time or have to use bonus depreciation, right? So these are these safe harbors available for taxpayers with these rentals that, I personally think they're underutilized and they're out there that make life a lot easier and make your bookkeeping a lot easier as well.
Yeah, that's great. And a couple of things I just want to comment on. So number one, if people are interested in hearing more about these safe harbors, the episode that just came out on April 30th, our last episode that we do talk in detail. Me and Tom were talking about that. So feel free to go back and listen to that if you want to hear more of these de minimis safe harbors. But the second thing I was going to say too, I'm also in a house hack. I think this is my third one that I'm currently in. So we live in the upstairs, rent out the basement. Same thing as far as bookkeeping. It keeps it really simple. Anything that is just for my unit that I live in up here, I'm just running through my normal kind of checking or savings account, but I have a completely separate account where I'm keeping track of mortgage payments, repairs and maintenance, cleaning things, whatever, and keeping that separate. Again, like you said, and like most people are like, "Ah, I have to create another account." Well, you don't have to, especially if you're just in a tick structure, but it is going to make your bookkeeping and your life so much easier on the back end if you just set yourself up really well for success. So yes, you don't need to, but like Alex and I know, it sets you up well. And what you can basically do is have everything run through there that's related to the rental property, have all your income run through there. And if you're just doing something like Excel, you can just download all the bank transactions for the year and then sort it that way. If you're using something more sophisticated, like some sort of software like QuickBooks, great, right? Link everything that's related to the rental in there. But when you've got this kind of mix, like we have with House Hacks, you have one mortgage payment, but now you've got to split that, right? Whether it's half of the square footage, and we can talk more about that too. For me, it's about a third of the square footage is for the rental. So about a third of my mortgage interest, my property taxes, utilities, interest, insurance, I don't remember which ones I mentioned. All of that is going to be related to the rental. And now that's kind of part of what you're helping yourself do by having everything run through that one account. So absolutely agree with you. And then just the last thing to circle back on from what you've said, when we think about what can be deductible, I just want to kind of say it a different way. When you were mentioning, say, the de minimis safe harbor, the things that can be deductible are things that are related to the rental property, right? Things that are related to that unit can be, but a common question we've heard is, hey, if it's a rental or it's a part of it, can I write off a portion of some of the paint or something that goes into our unit? The short answer is no, or like the utilities and your portion of the interest, all those things I just mentioned. So when we do house hack type things, it's a little bit of complexity because you might have one payment to kind of be split among personal, right, which we can't deduct, and what is the rental, which we can deduct, for example, on our Schedule E. So anything else to add there you think would be helpful for people?
That was well said. I think that pretty much summed it up.
Awesome. So we're, tax advisors. We talk about cost segregation studies with our clients all the time. Did you end up doing a cost segregation study on one or both of these properties?
I did on my first one, and we did on our second one as well. I was fortunate enough to see them, at my prior firm, and knew the benefits of them. And so actually I was able to take advantage of the passive activity loss allowance, which is kind of goes under the radar because it does require you to have an income essentially under 100K, but really the cap is 150K. It starts to get phased out between the 100 and the 150. But at the time, being in my 20s, I was making less than 100K. I was single, so I didn't have to worry about like my spouse's income. It is a combined test. And so at the time, I performed a cost seg, and about 25% of the building ended up getting allocated, roughly about 25% to the 5 and 15-year buckets. And we were able to take 100% bonus depreciation as I bought that one in 2020. And I think the loss came out to be about 22,000, I want to say, at the end of the year. So I was able to take that loss against my W-2 income, which is pretty incredible and pretty awesome. And some people just don't know about that. So it's just another benefit of this house hack. So I was able to live very cheaply. I was able to own the asset, and on top of that, I was able to take advantage of the tax benefits, even though it is a passive activity.
Yeah. Very unique situation there. And I had the same experience. I ended up not doing any cost segregation studies. I essentially had enough losses to not even need that to get, which is unfortunate. And we can talk about that another time. But at the end of the day, like same thing, like being under the 100,000 modified adjusted gross income. It's a very powerful for lower income folks, or if you're single and you just got your own income and like you said, not concerned about another spouse increasing that modified adjusted gross income. Like you said, just to hit this on the head again, that is whether you're single or married, which is a very unique part of this whole up to $25,000 that you can take less than 100,000 modified adjusted gross income. And what's also unique that we've talked about internally that I'll just let our audience know is that number is not adjusted for inflation every year. Right? Certain things in our tax world are adjusted every year for inflation, or, they relook at it. This is one of those things that is not, and this came out in like the 80s. And so one of our coworkers, if you're a longtime listener, Justin Shore, he did some math, and I can't remember offhand what he came to, but that 100 or 150 today's dollars would be like 300 something, right? So a lot of us in today's dollars, if they had continued to take this, we would be taking losses every year from our rental properties. But unfortunately, the way they wrote it, and I think they have no intention of changing that, we were stuck at the 100,000, unfortunately. So just a little tidbit of history as well, and perspective, I think, for people as well, as we think about maybe that was more relevant in prior years, but especially in today's dollars, it's really for those lower income people who are kind of just getting started, or starting in their career, or just a couple rental properties and so forth. But yeah, so then you got the benefits, took those losses, actually offset against your W-2 income. Again, kind of a exception on top of real estate professional status and the short-term rental strategy. What about selling that? Because we talk about, okay, we do a cost seg. Should I do that if I'm going to sell it in a couple of years? Talk to me about recapture and things like that.
Yeah, great point. So when you buy real estate, you always plan to hold it for a long time, especially like a rental, a nice, duplex rental. And what happened was really like the market just took off, like obviously went insane. And so I started pondering the idea of selling, and it really, like, as I thought more and more about it, it made more and more sense. However, like you said, that cost seg is going to come back. And once I sold, it might be in the butt a little bit with depreciation and recapture. And that's going to just get the benefit I got from it, right? It's basically just going to get reversed, right? So the depreciation recapture amount is going to be taxed on an ordinary income rate. And then the capital gain portion is obviously going to be at capital gains rates, because I owned it for over a year. I owned it for about 2 years, a little over 2 years, I should say, just to confirm, because I'm about to talk about another capital gain exclusion here in a second. And so we put it on the market for about 260. It did have some stuff wrong with like the foundation, so I ended up getting 245 out of it, and they paid the closing costs. It was a seller's market. And so at the end of the day, I walked away with about 32K of cash. And the 2.5 years I owned it, I had about 5 to 6K into it total. So it was kind of a no-brainer from that point of view. I had a lot of leverage on it. The market was hot. I had another property now, with a lot of leverage as well. So it just kind of was the perfect storm to say, okay, let's go ahead and take the win. And even if it means, obviously the depreciation and recapture and getting taxed at ordinary rates with that piece. But so the benefit of that also, so let me talk about the home sale exclusion, the 121 home sale exclusion. So I owned it for about 2.5 years, and half of it was personal, right? It was my personal residence. I lived there for 2.5 years, and it's really to test is 2 out of the last 5 years being your personal residence. And so the personal piece of that property, half of it, was eligible for the home sale exclusion. So that capital gain, which I had, the 245 minus the 200 purchase price, the capital gain alone, half of that was excluded from the home sale exclusion. So that was also just another benefit and another point towards selling the property at that point.
Yeah, and for people to keep in mind, just as Alex was talking about that, so essentially the whole time that you owned it, 50% was primary, 50% was rental. So you could only use that section 121 capital gain exclusion. For single, it's up to 250. For married filing joint, it's up to 500. You being single at the time, you could have taken up to 250, but you basically were able to say, hey, total gain here, half of that I can basically exclude because it was nowhere near the 250. And then the other half, that's essentially just going to be, like you said, capital gain. And then obviously you've got some depreciation recapture from the amount of years that you owned it. And that, was essentially a lot because of the cost segregation study and how much you had accelerated. So you've got multiple aspects. And I know you didn't do this, but just for our listeners, if you are wondering, could I do a combo of section 121 and a 1031? The short answer is you could. Okay. You would need to work with a qualified intermediary to make sure that that is done correctly. But basically the portion that is subject to that tax, that gain, whether capital or depreciation recapture, yes, you could do a 1031 if you're looking for a very efficient exit strategy. You didn't, and that's fine. You were just like, hey, I got my benefit. It sounds like I don't need to do anything else here. And obviously, as you talked about the numbers, a great return on your investment. But yeah, anything else to add into that from what I said?
No, I think that pretty much covered it. I mean, as well. I mean, beyond the 1031, I mean, I know you talked about a lot on the podcast too. Is that especially at that time when bonus depreciation was 100%? If I really wanted to, I could have went and bought another property that same year, right? Because being only half the property, it was like 100K, right? Unit for that rental unit. So any other investment I would have made that year in the bonus depreciation, if I performed a cost, I would have most likely wiped that gain out. So that would just been another way to get rid of my depreciation recapture and that tax if I wanted to do it that way.
Yeah. So one thing that I have talked with other clients, and I'm sure people are wondering, how in the world did you come to conclude that I'm going to sell a property that has debt at 3 or 4%? What was like your justification? How did you say, yep, I'm willing to forego, this low interest rate? Like what was like the greater, I don't know, prize in order to give that up?
Yeah, no, that's a great point. And like I said, it's certainly something like I wrestled with. That was a point towards keeping the property for sure, because I mean, that's pretty much free money, right? It was really hard to get rid of that debt. Now I had two of them and I had, highly leveraged both of them. So I wasn't super comfortable with having that much debt. Another piece was my unit was then going to be empty, right? I was moving out. And so the time I would have had to take to get a tenant in there, to find the right one, to manage it, it just made sense for me to take the cash off the table, to get rid of the debt, and to sleep better at night. And I did go purchase a single family house with now my wife, and that's kind of where we put the proceeds towards. So it wasn't an easy decision, but it was I think it was the right one for me.
Yeah. Yep. Take the return out of there, get the cash out. You essentially put it into another investment. It's a single family. So whether your philosophy is, yes, that's an investment or not is up to everyone's interpretation. I know that's kind of a debate out there, but totally makes sense. I mean, you kind of put it back into real estate. Absolutely. As we kind of wrap up our time today, is there any like final words or recommendations or advice you'd give to people just considering doing a house hack?
Yeah, great question. I have a few points here. And the number one point would be specific and be patient with your search. You don't have to be as patient as me. You don't need to wait like 2 or 3 years or to find the right one or anything like that. But be specific in where you want to live. Okay, it's important. You are going to be living there. And so take that into account. Can I spend time here? Can I be here? Am I going to, have a quality of standard of life to be at this house? And not just that the numbers make sense and I need to go buy this deal, right? The second piece would be just the patience part is like, don't just rush into a deal to do the deal. Like know what numbers you should be looking for from an investor's perspective, which I know is not our forte. So we're not going to go too far into that, but know what you can afford to live with per month. And if things went south, like what can you handle, right? If things worst case scenario, like I wanted to know I was going to be okay. So I was specific and patient with my search. And another thing I would say is get super familiar with your personal finances. And this isn't like you have to do it, but I think it was super helpful for me, like just to audit your net worth statement, audit your cash flow statement, like how much am I bringing in per month? What are my expenses going out? And making sure that that's dialed in. And that just allowed me to have confidence to move forward, to get the deal done, because I knew like what my financial situation looked like. And the last thing I'll say, and we've kind of hit on this too throughout, is just like be prepared for anything. Okay. Assume it's going to be hard and assume the craziest stuff is going to happen. Okay. And that even could be as simple as like all the utilities are on one bill, right? And figuring out how you're going to have to split that and how that's going to shake out. And again, what's personal, keeping personal and keeping business and being able to track that. And really the more organized you are, the better. But really just find the right property for you, the right fit for you. And again, if I could go back and do it, I would do it in a heartbeat. There's not really many better ways to build wealth, especially if you are single male. Okay. I don't want to leave out the females, but like being a single male, I lived places where I don't know if I would want my wife to now live, So I was able to take a risk and do that sort of thing. So that'd be my advice. I know you've done a handful of these as well. So yeah, any final thoughts from you?
Yeah. Well, for me, all of the house hacks I've done, which is 3, I'm in my 3rd right now. All of them, I haven't sold any rental properties. All of them were, yes, you run the numbers. And the time frames that you and I are talking about are like 2017, 2020, things like that, where the market was very different. We talked about interest rates being very different. The market now with much higher interest rates and prices have in some areas come down a little bit, but not substantially. I think overall, the real estate market is harder to get into. There's just less deals out there to be had. But if you are like, this is what I want to do long term, house hacking is a very good entry point. Like you said that a couple of different times, and we've talked about otherwise on our podcast. It's a very good entry point. It can be done whether you're single. It can be done whether you're married. The second one that we did, because I was married, it was in a much better area that essentially allowed me and my wife, my family, to go and acquire another property for much less down. You get a lower interest rate. and you're getting all the substitution of like lower cost of living, right? So there's a lot of benefits there. And if you've got a second person, you just need to come to that intangible almost, not just like, do the numbers make sense? Because you might be in a not as great of a part of town, but if you can still make it work or at least significantly reduce that cost, great. Then you've got a benefit there. Not to mention, right, appreciation, all those things. So I would say if you can get started that way, that's a great way to get started. Again, much lower down payment, all those things. And if you can, hold on to it. But if you are going to sell, you do want to keep in mind that 2 of the last 5 years rule that we were just talking about for you. That is really important because depending on the growth that you've had, the appreciation, if you kind of let that 2 of the 5 years lapse and then you sell it the year after, okay, now we've got a very different tax situation. So just keep in mind, you've essentially got a little bit of a deadline coming up that if you pass that, very different tax implications. So you need to be thinking through, anytime you move, am I going to rent this? Am I going to sell this? That ultimately is any home that you have. And some people just are not landlords, and that's fine. But that is always a decision that you'll need to think about of the 2 of the last 5 years. So at the end of the day, it's a great way to get started. And yeah, this is a great conversation. Thanks, Alex.
Yeah, well said. Yeah, thanks for having me. I appreciate having me on.
And as we kind of wrap up, just want to comment and say, if you are listening to this and you are looking for an advisor, we are accepting new clients, both for tax strategy and tax preparation. We do have that. And if you're a CPA, an EA, an accountant, and you're looking to make a shift now after a busy season here, we are looking for tax associates and advisors and things like that. So please reach out to us. We would be interested in hearing from you and seeing if we're a good fit for you as well. But Alex, thank you for joining me today. And it's been a pleasure talking through this. And we will talk with you and everyone else next time.
Sounds great. Thanks, Ryan.